GM, good morning. Welcome to the Milk Road Show, the daily crypto show where the cycle's changed, the players are bigger, and the dumb money isn't just retail anymore. I'm your host, Jay Hamilton. It's Tuesday, May the 6th, and today we are joined by Jeff Dorman, CIO and co-founder of ARCA, a digital asset investment firm. Today, we are going to discuss, is this a bear market rally or a bull market trap? We're going to look at who are the buyers right now and the difference between retail versus institutional sentiment. We're also going to talk with Jeff about what segments within crypto he is most excited about, where he sees the biggest upside, and which tokens he is paying attention to. I'll give you a hint, guys. It's on the fundamental and the buyback side of crypto. We're going to get into that and so much more today with Jeff. Before we jump in, tomorrow we'll be going live with Matt Crosby from Bitcoin Magazine Pro, talking all about Bitcoin for this cycle and predictions there. So if you want to tune in to learn about Bitcoin and where we think it might go, tune in tomorrow, 12:05 p.m. Eastern on YouTube and on X. Today's episode is brought to you by Ledn. Get cash without selling your Bitcoin. It's also brought to you by Coinshift, powering top crypto treasuries with their yield-bearing stablecoin, USDL. Without further ado, Jeff, welcome to the Milk Road Show.
Thank you for having me. How are you?
Absolute pleasure. Doing great, my man. Doing great. Things are good right now. You know, vibes. We're in a little bit of a green run right now. It feels nice after several down months. Let's before we jump into the specifics of where we are right now in this week and what we're noticing, let's just zoom out for a second. I always like when we get somebody on the show for the first time to get what's your base case right now for where we are in the market cycle?
When you say market cycle, I assume you mean crypto cycle?
Let's stick with crypto.
Or overall? Yeah. Okay. I don't believe in crypto cycles, so we'll start there. I think n equals 2, right? We've only seen 2 of them, and everyone just assumes that means these 4-year cycles happen forever. I think ultimately we're probably getting to a point now where almost everything that's happened in the past in crypto is completely irrelevant, and the next 40, 50 years will look similar to the equity market, where you have incredibly long periods of bull markets and then very short, fast drawdowns. There's a reason the mentality of buy the dip exists so much in equities, is because the data tells you to do that, right? You get 7-year bull markets where you make 4, 5, 600%, and then you get half a year to 1 year bear markets where you lose 20%, and then it repeats again. That's more typical of what markets should look like, because if you have investment vehicles that people actually want to buy that produce real revenues and cash flows and have real fundamental earnings. So in terms of where we're headed, I think it's a little binary right now, in the sense that either everything that Trump and the administration is doing here in the US from a tariff standpoint just immediately gets rolled back and becomes a complete non-factor, and we move forward and move ahead as if none of that ever happened. And you look at the 6-week sell-off from call it mid-February to early April as just a blip, no different than kind of like the COVID blip in March of 2020, or the last Trump administration towards the end of 2018. Or we're heading towards some sort of real recession, but we won't know if that's actually happening for at least 6 to 12 months, because these things don't happen overnight. Either way, we're probably going higher in the next 4 to 6 months while we figure that out, right? We're either going higher because this is much ado about nothing, or we're going higher because you can't stay short forever when there's absolutely no new news and no information happening until we ultimately do hit recession. Like, even if you look back at 2008, for example, one of the worst recessions we've had, the markets, that recession really probably started, call it like middle of 07. And the markets, you had all kinds of news happening from middle of 07 till the end of 08. But the end of 08 is really when the recession happened and when markets really tanked. In fact, from the day Bear Stearns went down in March of 2008 until basically Lehman went down in September of 08, the market screamed higher, even though it was pretty obvious that we were heading towards some bad things. So I think either way, you're probably going higher in the near term, but it's incredibly binary in terms of what happens thereafter.
What probability would you assign to each of those outcomes, each of those scenarios?
Right now, I'd probably say 80% much ado about nothing and 20% heading towards a recession. Only in the sense that if you look at all of the hard data, everything's fine, right? Earnings have been fine. Manufacturing data has been fine. Jobs reports have been fine. There's really nothing that we've seen in the actual data that suggests that there's any real slowdown in consumer spending or in GDP. When you look at all of the bad data, it's all survey data. It's all expectations, right? It's business confidence. It's inflation outlooks. So as a result, I mean, there's a finite window for how long this game of chicken can go on between the U.S. and other countries on the tariffs before it ultimately does start to seep into the real numbers. But it hasn't yet. Because again, all of this could just be unwound with a magic wand overnight if you roll back these tariffs. So it's 80-20, and probably each day it's kind of like a decaying option. Each day that goes by that we don't really get any resolution makes it 79-21, 78-22.
When you look at who's buying right now, there's a real separation between retail and institutional, right? Institutional is extremely bearish, and retail is clearly piling in and buying the dip, as you said. How do you think through those two sentiments?
Well, it's happening. I mean, the retail is buying the dip in equities for sure. I don't think that's happening yet in crypto. In fact, it's probably
you don't think so. But look at all the altcoins that are like there's some real rips in the altcoins.
Yeah, I mean, but
not the major altcoins, not so much the fundamental base. I'm talking like down the risk curve altcoins. We're seeing some returns that I wouldn't expect to see, but those also are crypto casino crowds, so those guys don't go away.
Yeah, well, let's start on the equity side. Right? On the equity side, again, a lot of the macro dooms sayers that have been out there calling, 25 of the last one recessions, that's what they get paid to do, right? These macro guys, they don't make money actually in their funds. They make money selling newsletters because fear sells. So you have all of these, doomsday guys out there selling newsletters, talking about how the world is ending. It's bearing people up. It's getting investors to think about worst case scenarios. And again, that could happen. There is some probability that happens, but in my opinion, it's just unlikely. And then you look at the way Wall Street strategists have been predicting things for the last couple of decades. They've never been more wrong than they have been in the last 4 years. I mean, they were all calling for a complete depression after COVID that never happened. Then they were calling for, 50 bips of rate hikes in 22, and we ultimately got 450 basis points. I mean, they completely whiffed on that. Then they were calling for massive rate cuts and a recession in 23 that we never got. Then they were all bared up in 24, and we hit all-time highs again. Then they were all bulled up ahead of 25, and now they're all cutting their estimates. So, the institutional money has just been wrong. And I think a lot of that is systemic in the sense that, these guys used to run all of investing because there was limited access from retail, right? It was hard to get a brokerage account. Most people poured their money into real estate rather than stocks. Now you got 24/7 trading on Robinhood. Everybody owns a brokerage account. It's easy to get a crypto account. Like the retail just drives more of the flows now than ever before. And retail is conditioned, rightly or wrongly, to buy the dip. And it has been working for, the better part of a decade and a half. And more likely than not, they will be right again, because again, the data shows that these sell-offs, even if it does lead to a recession, tend to be quick and shallow, and these periods of prosperity are long and prosperous. So I think retail's probably right again here, and you probably have this institutional macro crowd just panicking. Some purposely because they actually are looking ahead and think that the world is ending. Some just because they were over levered and were sellers. But either way, we've seen the fastest move from bullish to bearish in terms of sentiment on Wall Street that we've seen, again, since COVID. So we'll see. But on the crypto side, I do think it's different. And that chart that you're showing there from my latest write-up, like that's the equity market. I think that is what crypto will look like again in the future here, even though it doesn't look like that right now. Right? Crypto is probably the opposite of that right now. The sell-offs are long and painful, and then the periods of prosperity are incredibly fast and high, but they don't last very long. But I think in crypto, we're not seeing that retail bid yet. Coinbase rankings and Robinhood volumes on crypto are still way lower than they were in 2021. You're certainly not seeing a massive rush of capital coming into.
No new capital. Yeah,
no new capital coming in. So I don't think retail is rushing to buy the dip. But also, I think we have to use the word retail probably a little carefully. Like there's actually, when you talk about institutional investors in crypto, you're talking about funds like mine. Like couple $100 million to $1 billion hedge funds that are actually managing outside capital. But when you talk about retail, there's really two types of retail in crypto. There's the true retail kind of, weekend warriors that show up on Coinbase or Robinhood and place a trade here and there. But then you have like, the super wealthy crypto native retail that don't have jobs, but they're pushing around hundreds of millions of dollars of capital in the same size that funds are, doing all kinds of on-chain farming and things like that. So I think the crypto native retail is starting to come back. I don't think the true kind of, place a few trades here and there retail has really come back in, and we just aren't seeing it in the numbers. And you mentioned some of the high flyers recently. I mean, some of those things were like, some of the AI coins, for example, that were down 90% year to date. Yeah, they just rallied 100%, but they're still down 80% year to date. I mean, it's like, this is not indicative necessarily of money coming back in. It's more indicative of just how oversold some of these.
Just a regression to the mean, basically. Yeah. How much of the crypto sentiment do you think is still affected by the FTX crash of 2022 and the hangover from the last market? Because as you said, the crypto market does not look like that S&P 500 chart yet. We are still an early asset class, an innovative asset class. You're investing in early tech. There is going to be massive volatility. Do you think that we're still affected by that? And do you think that there's going to be a shift and a change?
Oh, for sure. I think the PTSD from 2022 is very real. And again, it's not unique to crypto. I mean, if you go back to 2000, 2001 in the equity market, or if you go back to 2008, 2009 in the equity and credit markets, it takes a long time. I mean, I started my career in 2000 and, had an 8-year career before the 2008 wipeout. And I lost half my net worth in, a matter of a couple of months. Which obviously was not a lot at the time. I was still young, but lost half my net worth, lost my job. I got fired from Merrill Lynch. I would say, even though the markets bottomed in March of 2009, it was probably end of 2011, mid 2012 before I even really started investing seriously again in equities, because I just didn't believe it. It takes a long time. In fact, even if you look at the chart, right? I mean, most people look at an equity chart from March of 2009 and be like, oh, we've gone straight up for 15 years. And the reality is we went straight up from March of 2009 to September of 2009. And then we went nowhere from September of 2009 until like middle of 2012, because people were beaten up by that. They weren't in a rush to put money back. People still, if you go back to that 2009, 2010, 2011 period, like at the time you had European banks and governments blowing up. You had the acronym, the PIGS, Portugal, Ireland, Italy, Greece, and Spain, blowing up. People thought we were headed towards a double dip recession, massive calamity. And of course it didn't happen, partly, if not mostly, because of government intervention, and ultimately it led to a 15-year bull market with a few blips here and there. I think that's probably similar to what we're seeing in crypto right now, which is that, 2023 was kind of that fast move off the lows. And then we've pretty much gone nowhere from, call mid 2023 till now, because people don't trust it. But it's going to come back, and it will come back, and it will be led by real projects and real tokens that have good tokenomics with buybacks and dividends and things that actually return capital to token holders. And ultimately, you'll look back 10 years from now and be like, I was too hesitant. I should have just been all in, because this is the future of investing and the future of finance. But people are still expecting these 80, 90% drawdowns because they're anchoring to 2022, which was like a once in a lifetime storm. I mean, that was not a typical sell-off. Every single counterparty was failing at the exact same time. You didn't know where to put your money because, Genesis was imploding and BlockFi was imploding and Celsius was imploding and FTX was imploding. Like that's not a typical sell-off. That was very 2008 like, where, Bear Stearns and Lehman and MF Global were failing. Like that's not the norm.
That's rare.
But it is the norm to take a couple of years to feel past that.
And as you said, when we only have a very limited number of years to look at for history, there's not a lot of historical data. We've only been around for a few cycles. I know you don't believe in the 4-year cycle, but we've only been around for less than 10 years. Really, a lot of these assets are quite new. So there's going to be a lot of volatility in that. I want to talk about some tokens that you've been writing a lot about recently, Hyperliquid and Radium. But first, I just want to talk about a few. You have a great post pinned on your X about the hills that you are going to die on, and some beliefs that you really hold. And one of those beliefs is that we should ditch the term altcoin and give a better terminology to all of the various crypto assets that we have. Which categories within crypto are you focused on, and do you believe are going to outperform?
Yeah. I mean, I think the term altcoin needs to be deprecated immediately. Like, it makes no sense, and it really it goes down to the fact that ultimately what crypto is just a wrapper, just like the ETF is a wrapper, right? You can put anything inside of an ETF now. You can put stocks, bonds, real estate, commodities, currencies, actively managed funds, short 2x levered funds, right? It's a wrapper, and anything can be put inside of it. But the first ETF was SPY, right? The spiders. And, just because that was the first one doesn't mean that that's where it stopped. And, if you asked anybody right now, like, hey, are you an ETF investor? They'd be like, well, what are you talking about? Like, what kind of ETFs? Do I buy bonds? Do I buy stocks? Like, the ETF itself means nothing. It's just physically a vehicle that you put things inside of. Like, that's ultimately what crypto is now too, right? The first type of crypto was Bitcoin, a cryptocurrency. But now a token is just a wrapper that you can put equity-like tokens inside of. You can put debt-like tokens, currencies, commodities, utility coins, meme coins, all kinds of things can fit inside of this, right? And the idea that all of this stuff should just be mentioned in one breath as altcoins because they're not the first is insanity. I mean, it will sound as stupid as saying, did ETFs go up or down today? Like, that makes no sense, right? And that's what it will sound like when we talk about altcoins in the future. So when you look at the types of tokens, first of all, you have different issuer types now, right? You have people and celebrities issuing tokens. You have actual companies. You have decentralized entities. Soon you'll probably have governments and munis. You'll probably have universities one day. So you have all kinds of issuer types. Then you have all kinds of sectors, right? You have, cryptocurrency, you've got DeFi, you've got DePIN, you've got gaming and AI and stable coins. I mean, these are all incredibly different. And again, packaging them all together is just nonsense. And then within that, you have different tokenomics, right? I mean, some of these are just completely inflationary. Some of them are the opposite. They're buybacks. They're amortizing. And when you look at all the nuances, crypto looks a lot more like fixed income than it does anything else, right? You think about the fixed income market. You have government issuers, municipal issuers, corporate issuers. You have all kinds of coupons and maturities and covenants and callability structures and convertibility features. I mean, that's ultimately the nuances of the bond market is what we're now seeing in crypto. Even the Trump coin is a good example, right? I mean, the Trump coin started as a meme coin with no utility. And then what did they do? They added utility by saying, if you have a certain amount of tokens, then you're eligible for a dinner with the president. And independent of, I know every time you mention Trump, it elicits a binary and, pretty vivid response.
Visceral response.
Visceral response, yeah. But the reality is, like, objectively, without doubt, regardless of what you thought the Trump coin may or may not have been worth before the announcement of the dinner, it is worth more after the announcement of the dinner because there is real value ascribed to that. And you can do that with any token. You can start a token that has no value, and then you can all of a sudden add a revenue feature or a buyback feature or a utility feature. And I always break down I always break down the value of something in three ways, right? It either has to have financial value, meaning you have real revenues and cash flows, and those are being used in some way, shape, or form to add value to the project, right? Either in the form of, reinvesting in the business or dividends or buybacks or something. Two is it has to have utility value, right? Something that it's useful for something, right? You can use it for, in the crypto world, paying gas or collateral, or, in the case of a Trump dinner, something like that. There's some usage that you get. In the non-crypto world, you're talking about things like Starbucks rewards or, United or Delta miles, things like that. And then there's a social factor, right? The cool factor. Is it cool to be a part of this, whether that's a community or Tesla, for example, there's a cool factor to being a Tesla investor. Obviously, so when you look at those three things, ultimately financial value is the one that people understand the most and have a much easier way of identifying what that value is worth, because we now have 100 years of history of Graham and Dodd and Warren Buffett and cash flow analysis. You give 10 financial analysts the exact same inputs, they're going to give you the same output because they all use the same methodology. But that utility value and social value is where it gets a lot harder. They absolutely have value, but nobody really knows how to value it. And that's where a lot of the alpha comes in, is trying to figure that out.
Okay, I want to shift over to a couple tokens that you've been doing a lot of research and looking into, Hype and Radium. Before we do, we just need to take a quick moment to hear from our sponsors who make the show possible. Selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, the trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over $9 billion in loans and never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn, spelled Ledn. Meet USDL, the stablecoin built for institutions and DAOs. Don't just hold basic stablecoins, earn yield, all without compromising security, backed by regulated real-world assets and secured with institutional-grade risk management by our friends at Stakehouse Financial. Put your treasury cash to work, earning native yield and protocol rewards, built by the team behind Coinshift, which is trusted to manage over $1 billion in business treasuries on-chain, including Aave, Gitcoin, and hundreds of leading institutions. CYCS USDL is gaining traction at milkroad.com/Coinshift. All right, we're back. Jeff, let's talk about Hyperliquid. Hyperliquid has been a star throughout throughout this cycle. And I mean, I'm going to bring up the charts quick to show you look at the chart of how it's performed within perp trading and, look at it just take over this chart of, it was nowhere to be seen earlier in the year before it launched. And now it's leading the way. Right. So let's talk about Hyperliquid. What's your thesis on Hyperliquid? What are your thoughts here?
Yeah, and Hyperliquid, for those who don't know, is in the DeFi bucket. This is a perpetual exchange, a place where you can go trade futures on Bitcoin and ETH and a variety of other tokens as well. Similar to others that you've seen in the past. Things like, obviously on the centralized side, you've got Binance and OKX and Bybit and others. FTX used to be a big player. On the decentralized side, it's been a little bit of a game of hot potato until Hyperliquid came. You had DYDX leading for a long time. There's
GMX.
Others like GMX and Drift and others, but Hyperliquid, really came out in the last year and a half, and in our opinion, probably one of the most exciting projects since the BNB token back in 2019. Right. So if you go back to like Binance, why we were so excited about Binance 6 years ago was, in my opinion, they figured out the perfect use case for a token, which is to become one of the greatest capital formation and customer bootstrapping mechanisms ever created, right? They issued the token to their customers, and then they said, we're going to use 20% or so of the profits of the business to buy back tokens. That's the financial value. But they also said you could use the BNB token to get trading discounts on their platform and to use it as collateral for trading futures and trading options. That's your utility value. And then, obviously CZ being a big character, created some social value. So that was a good example of a token that had all three. And obviously BNB went from, $4 to $600 or $700 at the peak, because they did all those things right. You had a profitable entity with a good user experience that nailed the financial utility and social value. Hyperliquid is basically doing the exact same thing, but on the decentralized side. First they nailed the user experience. People really like to trade on there. It has a really high ARPU for those who are more, traditional financial guys, average revenue per user, meaning, they have sticky customers who like to trade there. And then after they started to build a good product, then they issued the token and they did an airdrop. I think it was like 30 or 33% of the tokens were just airdropped to their customers. And the rest were obviously held by the foundation. And they never did a VC deal. They never sold any private tokens to anyone. And then they built this the right way, which is they immediately said that all the revenues of our business we're going to use to buy back tokens. Currently 93% of their revenue, and they're making somewhere around $1.5 million to $2 million a day in revenue, is being used to buy back the tokens. So right there, you've got your financial value. They're now instituting the same Binance playbook of utility value. They're instituting a fee tier where, depending on how many tokens you have and you stake, you get lower trading fees on the platform. There's your utility value. And not to mention, they're also building this on their own layer one blockchain. So there will be other opportunities to use the token in the future as, a launch pad for other apps and products that are built on the layer one. And then, the social value. I mean, all you have to do is type in Hyperliquid on, X, Twitter, and you can see that, like, people are talking about this, and they end every tweet with Hyperliquid, right? As sort of like a, no different than when CZ would hold up 4, or all the other things in the past that when things go viral. So again, here's a project that is making, run rating somewhere between 500 and $1 billion a year. They're pouring it back into their own community, because don't forget, like, they didn't sell tokens to people; they just airdropped them. So they're if you think about why tokens are so exciting in the first place, it's just the first vehicle that's ever fully aligned and incentivized all of your stakeholders at once, meaning your founders, your employees, your customers, your investors. They're all incentivized in the same way, which is to make the product better and to grow the token, right? And that's why I say that tokens are the greatest capital formation and customer bootstrapping mechanism ever created, because they instantly align all of your parties. And that's a huge win, right? Because if you are a customer of Hyperliquid and you own the token, you're going to become not only a power user, but an evangelist. You're going to start telling others to use it, and you're going to, praise them. And it's sort of the opposite of what traditional finance does. Like, imagine if you were, look at like a Venn diagram of McDonald's, for example. Like, how many McDonald's shareholders do you think actually shop at McDonald's?
Eat there?
Right. And vice versa, right? How many customers actually gain financially in any way? And you can go further. I mean, take DoorDash, right? How many of the DoorDash delivery guys and customers actually benefited from DoorDash's success? Or Amazon Prime, if you were the first Prime member and helped build that, did you get any financial success? No, unless you own the stock. Or actually, airlines are even the better one. For example, like, if you are a massive flyer on Delta, but you don't own the stock, do you really care about Delta's success? No, you just care that they have enough flights for you to use. You could care less about Delta's success because you're not aligned in the right way. So the tokens that are doing this right, when we use the term tokenomics, like, that's what we're talking about. Can you find a way to align all of your stakeholders, meaning your founders, your employees, your customers, your shareholders, anyone else tangentially involved in the community? Can you align them with a single goal? And Hyperliquid is one of a handful of tokens that has figured that out.
Yeah, I was just gonna say that. How many tokens do you think have figured that out? Because I agree that it's a handful. It's not many.
It's not a lot. It's not a lot, and probably in the 10 to 20 range. And a lot of them, unfortunately, have been exchanges, because those are the ones that are the most instantly profitable, right? So they're the again, a lot of times, so these companies and projects can't do it because they haven't made any revenues yet. So it is generally going to be these service providers that can generate revenue off the bat. But it doesn't have to be. I mean, there can be plenty of other businesses that do this. And if like Grass Protocol, for example, is a good example. Like, Grass is for those who don't know, they essentially are taking, compute from, everyday users who opt in, and using that for AI data generation. And they sell that data to, customers. HiveMapper, in the DePIN space, another example. HiveMapper, for those who don't know, has a token called Honey. HiveMapper, you physically buy a device, you put it in your windshield, and all of the customers drive around mapping a new version of Google Maps, and then they're selling that data to logistics companies and trucking companies. Like, there's real revenue coming in. So,
and they've mapped 30-40% of the world already in a few years, compared to how long it took Google to do it. I mean, there's an example of something that is working. We've had HiveMapper on the show before, so it's
right. But the difference is because and we are as well. But the difference is, like, DePIN by definition is inflationary, because they have to use the tokens to incentivize you to do the actions. Whereas these exchanges can be amortizers, right? Where they can actually issue all the tokens up front and then buy them back over time. So there is a difference, but also, this is why I think the future of crypto has nothing to do with most of the projects that exist today. Like, the analogy I've been using is, if you go back to the .com days in the early 2000s, most of the .com don't exist anymore. Right? They were good ideas, but maybe too early, or maybe, didn't work for whatever reason. And a few of them, lasted, right? Amazon and Priceline and things like that. But a majority of them went out of business. But now you wouldn't call anything a .com, because everything's a .com, right? We lost the .com name because every single entity on earth uses the internet. Domino's Pizza is now a .com. Walmart's a .com. JP Morgan's a .com, right? Harvard University is a .com. Like, they're all, or .edu, but you get the idea. the growth of the internet had nothing really to do with the early internet native companies. It had to do with the fact that the existing companies that had been around for 100, 200 years figured out how to use the internet. And that's likely where we're headed with crypto as well. Is we're exiting the crypto phase right now, where the only thing that has a token is this crypto native company that would not have existed without crypto. But now you've got Trump issuing a token, right? And even though, again, it's a polarizing token and it led to things like the Libra token and other bad things, it ultimately sets a precedent for what will likely come in the future, which is Netflix issuing a token, Disney issuing a token, New York City issuing a token, UCLA issuing a token. Like, you're going to see better projects, your local bodega or local restaurant, your local barbershop, your local gym. Like, we're talking about ways to incentivize. Imagine a local gym says, hey, we're going to airdrop tokens to every single one of our customers, and you get a discount on your gym membership if you pay with the token or stake it. We're going to give 10 or 20% of top line revenue back to our token holders. It's the same concept. It's the exact same concept as Hyperliquid, only you're taking a business that could have existed with or without crypto. So I think that's where we're headed. That's where the better investment opportunities are going to be. It's not going to be in the 712th layer one blockchain with 10% inflation that has no usage. It's going to be real businesses that figure out that you can issue a token to align your stakeholders and to grow your business.
Yeah. The L1 trade is a dangerous trade. It's a trade of past cycles in my mind. It's oversaturated. It's VC backed. The inflation is never ending. There's going to be token locks that continue forever. It's not the trade that I think you should make anymore. I want to chat about token buybacks for a second, because you made this great chart, and then I want to lead into Radium before we wrap up here. When you look at the different token buyback programs that are out there right now, and there's not a ton of them, but there's a handful that are doing great and are really doing meaningful things. What stands out to you?
Well, the first thing that stands out is that I think we would have been here 3 years earlier if it wasn't for the Gensler SEC regime. I mean, it's not rocket science to use your revenues and cash flows to buy back tokens or to do dividends. What had changed was that the fear in the crypto world of retribution from the government, especially in the SEC, with jail time and fines, basically made every lawyer in crypto say you can't do anything that is good for your token. And as a result, it led to the stupidity of the meme coin phase and everything else that we've seen now with projects like Uniswap, for example, which makes a fortune and gives none of it back to its token holders because their lawyers and their VCs are telling them not to. So now that that's passed, and we are clearly kind of heading in a new direction in terms of government regulation and specifically with the SEC, but not exclusively, you're seeing that these projects are like, oh yeah, the best thing we can do is take our revenues and plow them back into the business, because guess what? That's going to lead to more users, and it's going to lead to more token holders, and it's going to lead to more business and thus more buy. I mean, it's just like, it's common sense. It is just common sense that this is what you should be doing. And you're going to start seeing a lot more of it. Now, again, the beauty of crypto and why you need to really, dive in, or maybe have a 10-person team like I have, running a fund, is that these are all unique. And, again, it's not like one token fits all. Every one of these has a different buyback schedule, has a different cadence, has a different mechanism for doing it. And you have to really dive in and learn that and read the white paper and be on their, discords and figure it out. But all of these projects mentioned here have a completely different mechanism of buybacks, and some of them have more revenues than others. But, you can see on the list there that they're heading in the right direction, that this is the way to do it. You want to depreciate the supply of your token. You don't want to inflate it away.
When we look at this list, we've got Hyperliquid, Aave, Jupiter, Radium, Maker on this list. All of these tokens fit well into the fundamental thesis of focus on the businesses with real revenue, real fundamentals. We've already talked about Hyperliquid. Which other of these are you paying close attention to, and do you like as potential investments?
Yeah, I mean, in general, we are certainly more geared up lately on DeFi for a couple of reasons. I mean, we have a pretty simple thesis. Let's just back up for a second. We have a pretty simple thesis right now in terms of where we're headed. Not just that we're sort of leaving this .com world or whatever .crypto world, but that ultimately, as every single entity in the world starts to use blockchains, and they will, right? Because we've just learned over time that blockchains work, right? Layer one blockchains work, DeFi works. It's just a matter of time before you get assets on here that people care about. If you think about what a blockchain is, a blockchain is designed to move assets in the same way that the internet moves communication. So if a blockchain works and it's designed to move assets, the next step is, well, what are the assets on a blockchain? And that's where you go crazy, because you're like, actually, most of the assets on a blockchain are terrible and nobody cares about them. And the only ones that people care about are, Bitcoin and stablecoins. So what are the assets people care about? Stocks, bonds, real estate, hard assets like, your cars and your jewelry and things like that. Like, ultimately, that's the next step, is we need to get the world's assets on blockchains. And once we do, who the winners are going to be, whichever layer one blockchains get chosen for that, right? So even though Ethereum and Solana have a big lead, we still don't know who is actually going to win that race, because we haven't seen the US government use blockchain yet in any meaningful way. We haven't seen Walmart or JP Morgan use blockchain in a meaningful way. Like, ultimately, whatever they choose, that's going to be the winner, because they have the majority of the world's assets. And then the secondary winner is going to be the DeFi applications built on those platforms, because that's where ultimately you're going to see all of the movement of assets, the collateral, the lending, the borrowing, et cetera. And then, what else benefits? Maybe some gaming companies here and there, a place where you can, benefit from having NFTs and on-chain assets, maybe things like AI, which help you navigate on-chain. Eventually you'll have AI agents that you just tell, hey, I want you to set up a wallet and send, 20 grand to this entity, and it just does it for you. So there will be a fair amount of winners. And that's sort of where we're focused. But there's a lot of tokens now within those that are doing things the right way. And again, most of them are in the DeFi space right now, or in the centralized space, right? Your BNB tokens, your Leos, your Radiums, Jupiters, Aves, Hypes, Athenas, Jitos, Litos, things like that, Aerodrome. But, we will see more and more better designed tokens now that, again, there's just less fear of retribution from the government. And quite frankly, if there's any investment bankers listening, like, get off your ass and do something. I mean, you guys are the most creative people on earth. You guys, I worked for investment banks for a decade. There's no shortage of creative people in investment banks coming up with structurings for, preferreds and convertibles and equities and debt. And, even one of the airlines a few years ago, they found a way to issue debt backed by their loyalty points, backed by their miles. Like,
that's incredible.
Tokens are just better capital formation tools. Like, go pitch a Disney token and say, hey, Disney, like, go issue a token, give 10% of your top line revenue back to token holders through a buyback, let them use the Disney token to pay for Disney Plus and to get fast pass at the parks and to get early access to IP. And, you'll have the greatest token on earth, and it'll be, it'll add a couple, $100 billion to your overall cap stack. And you can still have your stock being the asset that people buy if they want to have just, direct access to your cash flows. You can still have your debt, which is a claim on your, your assets. And then you can have your token, which is a claim on your customer loyalty and your growth. Like, there's, that is where we're headed, where tokens are the third part of a capital stack. Once these investment bankers figure this out and realize that there's no more retribution from the SEC. And again, where do these tokens trade? What blockchain are they issued on? Which DeFi applications are they used for collateral? Like, that's who the winners are going to be. It's going to be stable coins, protocols, and DeFi, and a few other ancillary sectors here and there.
How do you decide between Solana DeFi versus Ethereum DeFi?
Well, that's the problem right now, right? Is that it's so fragmented. There would be a good example would be, I think I got my first iPhone in 2008, and I'm not much of a gamer, but people were playing Angry Birds at the time, so of course I downloaded the Angry Birds app. Right? Angry Birds became popular. Of course, there's an iOS version and an Android version, right? It's not like they just said, nope, we're only going to use this for iOS, and that's it. It's like, that's the same thing's going to happen in crypto. Like, if my Disney token is a success, they're going to issue it on any chain where there's users. They're not going to be like, nope, we're just doing it on Ethereum because we have some pride in Ethereum. They don't care. They're going to say, okay, which chains have users? Oh, these ones? Okay, that's where we'll issue it. And you'll have, every app will be in every app store. So the apps will be the tokens and the applications, and the app stores will be the blockchains. And, there'll be a handful, 3, 4, 5 that ultimately win. So how do we think about it right now is, again, this is where it gets harder, because, Solana has a lead right now, being, second or third or fourth most used blockchain. But almost everything happening on Solana is complete nonsense. It's just memes and, stuff that won't exist in 5 or 10 years that nobody cares about. So it's like, it's a proof of concept, but with the wrong assets. So if you're betting on a Radium or a Jupiter, or, a Jito or something on the Solana blockchain, you have to have a little bit of a forward analysis that eventually these same applications that you're betting on today that are being used for memes will eventually be used for stable coins and stocks and bonds and other assets people actually care about.
Which, last question, Jeff, this is such a great conversation. I want to keep asking you questions, but we won't go too much longer because I know I'm taking up lots of your time. If we look at the rest of this cycle, what would you expect to outperform? Would you expect L1s to outperform, or and L2s in the infrastructure side or the DeFi side?
Yeah, I'm definitely more partial to the DeFi, the application side. I think the fat protocol thesis probably did more damage to crypto than anything, because it led to, just infinite bid from venture capital investors on, the 800th L1 that does the exact same thing. I think it's impossible for a layer one to capture more of the value than the applications built on top of it. In fact, you're already seeing it. I mean, like Tron's a good example, right? Like, why is Tron even a blockchain that anyone cares about? It's because they have a massive amount of tether, the stablecoin being issued and sent along that blockchain. So, I think Tether is 140 billion, and I think, almost half of it is on Tron, and Tron has a $23 billion market cap. So already the fat protocol thesis is dead right there. The value of the Tron protocol is less than the value of the assets on it, which is stablecoins. And then the only reason I use Tron as an example is because it's clean cut, because there's basically nothing happening on Tron besides Tether. But the same thing will be true of Solana and Ethereum and anything else, which is I think the layer one, layer two investments will go higher if all of blockchain continues to succeed and grow. But I think they will go higher at a much lower rate and a much more binary outcome than the applications. Because like I said, like Hyperliquid is a good example. If Hyperliquid wins, ultimately a version of Hyperliquid will be on every chain and will be compatible with every chain. If Aave continues to win as the Ledn borrow platform, like, they will vertically integrate and you'll have all kinds of trading and Ledn borrow and everything happening there, and it will be across every chain in some way, shape, or form. So I think it's just a better bet and a more probabilistic bet to bet on things like gaming, AI, DeFi, things that again can sort of exist across all chains rather than having to pick a winner.
Yeah, fantastic advice. Jeff, thank you so much for joining the show today. Really appreciate your time.
Absolutely. Appreciate you having me.
Thanks for listening in, everybody. Have a wicked awesome day. We'll see you back tomorrow with Matt Crosby from Bitcoin Pro Magazine. Thanks for listening to today's episode, y'all. Before I let you go, we've lined up a partnership with OKX, one of our favorite exchanges in the space. And with this partnership, if you are trading on OKX and you use the link in our show notes, you could get an opportunity to win $60,000 USDT from a prize pool that they have going right now. Why do we like OKX? A few simple reasons. It's got great trading options. It's cost efficient. They've got great tools, security and trust most of all as well. We really trust them. So check it out. Click the link in the show notes and get yourself a chance to win 60,000 USDT today. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.